Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back. Today we're going to talk about 3 reasons why you as a small investor have really big advantages over the pros. So at a Berkshire Hathaway meeting a few years ago, Warren Buffett was asked what approach or what would he do differently if he was investing smaller amounts of money, say in the sort of 1 to 10 million type range, I think was the question out there. And the crowd had a bit of a chuckle when, people are talking about multi-million-dollar sums as small amounts of money. But relative to what Warren Buffett is currently investing, which is hundreds of billions, a few $1,000,000 is absolutely nothing. And what he actually went ahead and said was he'd be much more inclined to go back to his older strategy of buying more Ben Graham type stocks, and he'd be doing 50% a year returns guaranteed. He mentioned that if you don't think that size is a massive weight on your financial returns, then you've probably never managed big money. So what I want to do is dive a bit deeper into what Warren Buffett actually meant by that and some practical takeaways for you as a small investor and why you've got some really, really big advantages over the pros that are managing huge funds. So the first reason why you've got advantages versus someone like Buffett who's managing massive amounts of money is quite simple. The amount of companies available for you to invest is in the thousands, whereas Warren Buffett has a very small amount of money. So that's the first one. The first one is just size and the number of companies. So as a small investor, someone like myself, I've got the opportunity to invest in literally thousands of companies around the world. If Warren Buffett wants to get into an investment that's going to make a noticeable difference in his net worth, he's probably looking at somewhere in the range of 30 to 50 companies. He's got about 1/20th or less the actual kind of number of companies he can look into. And when you've got a really, really big company, there's not often a time where those companies go on sale. So if you're not familiar, with Buffett's strategy, essentially it's to buy $1 of value for 50 cents. I've spoken about this a number of times on the channel already. That's Buffett's basic strategy, is to buy something that's worth $1 when it goes down and is priced at 50 cents or less for whatever reason. There's some sort of fear around that industry or around the general market, and it puts these things on sale. He scoops them up super cheap and is able to generate really high returns. So when you've only got 30 to 50 companies, it's much harder to find those 50-cent dollars. It's much harder to find things on sale. These are by definition the 30 to 50 biggest companies in the world. It's the Apples, the Facebook, the Amazon, the huge companies out there, and these are massively widely followed companies as well. So it's not often that these 30 to 50 companies go on sale. So as a small investor, you've got a lot more opportunity. You've got thousands of companies you can look into. Even in massive bull markets like we're in at the moment, there's bound to be something out there that's on sale that's within your circle of competence and you can understand. So that's reason number 1. Let's get into reason number 2. Reason number 2 is something called liquidity. So liquidity is essentially how difficult or how easy is it for you to move in and out of investments. So something that would be a highly non-liquid or illiquid investment would be something like your house. Although you can, houses are been bought and sold all the time, it can be quite a long process to actually find a buyer for your house, and it can take weeks or months or even years if you're trying to fetch a really high price to get out of that house. Possibly even a more extreme example would be if you own quite a niche private business. Let's say you own some sort of software business in quite a unique field. It's a small company, you haven't got a huge client base or anything, you're not overly well known. If you want to cash out of that business and sell it to someone, there's very, very few buyers out there. And that's one of the reasons why private businesses are typically much, much cheaper in terms of sort of a price to earnings multiple and that sort of thing than publicly traded companies. So when you've got a publicly traded company, those are highly liquid. For someone like myself, if I buy shares in Microsoft, for example, I can be in and out of Microsoft within, the click of a finger. Within seconds, literally, I can trade in and out of a public company because there's always buyers and sellers. There's massive volumes of shares being traded every day. So that's a big advantage to the stock market in general, and that's the reason why publicly traded companies typically actually trade for about 2 times the value of a privately traded company. So the very long-term average price to earnings multiple of the S&P 500, one of the major US stock market indices, is about 15 times earnings. That's typically what that market is traded for over the very long term. Private businesses, on the other hand, are usually somewhere in about the 7 times earnings range, and that's again going to vary on how fast the company's growing and all the sorts of things that influence PE ratio. But one of the main reasons why this is much higher is liquidity. So as a small investor, I can be in and out of stocks very quickly. Where this actually doesn't hold true so much in the stock market is for the really, really big guys. So I'm going to take the example of Apple and Warren Buffett buying Apple in terms of liquidity. So Warren Buffett has been buying Apple. If you don't know, he's been buying it very, very heavily. There was actually something in their 13F filing recently where they'd been selling a few Apple shares, and it's rumoured that that's not actually Warren Buffett. It's Ted or Todd, one of the other money managers, but that's an aside. So Warren Buffett has been buying into Apple for probably about 2 years now. And this is going to be a pretty extreme example. So he's been buying for about 2 years, and he now owns approximately 5% of Apple. He owns millions and millions of shares now, and he owns about 5% of the company overall, but it took him 2 years to do that. That's a massive amount of time to get into a company. I just said before, if I want to get into Apple or Microsoft, it takes me 10 seconds. So for Buffett to go out and buy a lot of shares in a company, he's such a big investor that it's putting massive upward pressure on that stock because he's trying to buy so much. And it takes a really, really long time if he doesn't want to just shoot the price to the moon. So in terms of liquidity, we've got massive advantages. For the average fund manager out there, we're probably talking weeks or months to get out. Buffett is a extreme example, but if something goes wrong with the company, or if we see a short-term price drop as an opportunity where we want to get in, we can get in and out very quickly. Buffett cannot. That's kind of the moral of the story. So let's get on to reason number 3, and the final reason why you've got a massive advantage over big sort of pension funds and all that sort of stuff as a small investor. And the final reason is something that is called the institutional, if I can spell that, institutional imperative. The institutional imperative. So if this isn't something you've heard of before, the institutional imperative essentially goes that if you're being paid to manage money, if someone's giving you their money in a professional context to go out and make a return for them, they're not going to be happy if you sit there and do nothing. So you're their stud baseball player, as an example. They've picked you as kind of the go-to person to manage their money, to generate some returns for them. So if you were to just go there and sit in cash and not do anything, they wouldn't be very happy with you. They'd pluck their money out of your fund very, very quickly and go put it somewhere else. So that's the institutional imperative. As a value investor, often there's tends to be kind of quite long periods of time towards the end of market cycles where value investors sit with a lot of cash. They're often selling investments because they're getting towards full value or even they're overvalued, and they're sitting with a lot of cash. And cash does not generate a high return at all, at least not in the short term. What cash does do is give you options. So if the market does move down aggressively, you've got cash sitting there so that you can, when it's raining gold, you can go out with a wash tub, not a thimble, and you can scoop up a lot of shares really cheaply and make some kind of big returns over the long term. Your returns are going to be dampened by sitting in a lot of cash in the short term, but you should be able to make that back and more in the long term by scooping up shares when they do drop down. So that's something that we're able to do as a small investor, is sit with a lot of cash and kind of just wait for opportunities. Have companies on our watch list that we want to buy. And once they get to our price, we can go and scoop them up. But in the meantime, we can kind of just sit there and wait. And this isn't something that the institutional guys can do. The big fund managers can't do this. People are going to pull their money out of the fund. And what that means is that if the market, say, drops 50%, if the market drops 50%, if we have a huge recession, that's not the end of the world to them. That is a smaller risk to those guys than sitting in cash and having their money pulled out of the fund. So something you have to understand about institutional investors is they're almost all paid on something called assets under management, AUM. Basically, how much money do they have in the fund, and then they typically take a percentage of that every year for management fees, and they may even take a percentage of the returns they're able to generate as well. So assets under management is the main goal for an institutional fund manager. The way you get assets under management is by essentially already having a lot of assets under management and generating some good returns. So if you're the biggest hedge fund in the world, you're going to continue to attract more and more money because you have that reputation as a big fund. And if you generate reasonable returns, market levels or maybe even slightly above or below, and you've got a reputation as being sort of a safe investment, you're going to attract more assets under management. What will not attract a lot of assets under management is sitting in cash for years on end. So they just can't do it. One of the rare examples of people who have set up their fund in a way where they can sit in cash is Warren Buffett. I talk about him 10 times every video, but essentially the way that Berkshire Hathaway is set up, as opposed to your typical sort of investment fund, is in a typical fund, you've got Joe Blogg's investor. You give him some money. If he doesn't make you any money, you can go ahead and pull it out, take it back essentially whenever you want. In certain funds, you can only do this maybe quarterly, or with someone like Mohnish Pabrai's fund, you can do this once a year typically. But you can kind of pull your money out whenever you want, and if you do pull your money out, that investor typically actually has to sell shares to do that. So if we're in the depths of a recession, and a period of time where you should be buying as many shares as you possibly can because they're so cheap, this is when huge returns are generated. You've got people in the public that are just wanting to pull money out all the time. You're having to sell shares at a loss because you've been forced to, and that's a massive downside of being an institutional investor. So that's your typical company. The way Berkshire Hathaway is actually set up. So Berkshire Hathaway is not a hedge fund or a mutual fund per se. They're actually a publicly traded company. So anyone can go out and buy shares in Berkshire Hathaway. But the advantage of this structure from an investment perspective is when Berkshire Hathaway first went public 50, 60, 70 years ago, something like that, they raised money. So in their IPO, their initial public offering, they first issued shares and they got money back for whatever projects they were working on at the time. And that's the only money they've ever raised. So typically in an IPO, that's the only money that company ever actually gets. From that point forward, their stock will continue to trade in the market, but oftentimes there's no actual direct benefit to the company. But what that means is if people want to get out of their investment, they can just get rid of the shares. They can just sell the shares that they own. And there's always another buyer on the other end if you're selling shares. But what that means from Warren Buffett's perspective is, you know, these shares can be bought and sold all you like on the side. What that doesn't actually force Buffett to do is sell shares to give money back. If someone wants their money back, then another person must buy those shares. So it's, you know, an even transaction. What Buffett doesn't have to do is sell shares at a loss. And what that allows him to do is sit with a lot of cash. If people don't like him sitting with cash, they can sell their shares, and Warren Buffett's none the wiser. He can still have cash. And it allows him to pick up a lot of shares cheaply in recession type scenarios. And it's one of the structural reasons why Buffett has actually managed to do so well over the very long term. He doesn't have to deal with the emotion of outside investors wanting to pull their money out at bad times and wanting to give them a whole bunch of money when prices are high, because that's unfortunately what the typical investor actually wants to do. They want to buy high and sell low because of fear and greed, rather than flipping that the other way around and thinking rationally about, you know, what's this thing worth and what's it currently priced at. So that's the institutional imperative. That's all my thoughts on why you've got big advantages over a fund manager. I hope you understood all those, and I hope you've really enjoyed the video. If you did, drop me a like and a comment down below, and I will see you in the next one. Cheers.